Manik Taneja as well, joining in from JM Financial to walk us through his outlook, not just on the IT sector, but in particular for expectations when it comes to earnings. Good to have you on board. Let's begin by talking about TCS's numbers. What do you think that the street is really watching out for? What are your numbers when it comes to the EBIT margin, the overall dollar revenue growth?
Hi, good morning. Thank you for having me on the show. So with regards to TCS for this particular quarter, we are expecting about a 3.7% sequential CC growth. Cross-currency headwinds will impair the reported USD revenue growth by about 150 to 160 bips for the name. And that's a trend that you will see across companies, but the extent will vary depending on the mix of their business across currencies. From a margin standpoint, you will see the impact of the wage increments that kick in the current quarter, along with the fact that across the sector, you will see the impact of travel and facility expenses resuming. And thereby, at a overall level, we are expecting about a 160 bips decline in EBIT margins on a sequential basis to about 23.4% for the quarter.
In terms of TCS commentary, okay, those were the numbers that you spoke about. What to watch out for when the management speak? It'll be the first commentary of Q1, probably the first outlook for the following year after 3-4 months have gone by. So what to watch out for?
So given the street has been worried about what's transpiring in terms of demand, given we've continued to hear concerns about recession not only in Europe, but even in the US. So how are clients pivoting in that backdrop? So over the last few months, we've had a very mixed, I would say, news flow. Some of the global tech peers continue to confirm that tech spending essentially is remaining fairly resilient. In fact, some of the global peers have actually even raised their midterm to long-term outlook amidst the current market volatility. While in the most recent past, we saw Duck Creek downgrade their outlook. With regard to IT services companies, the focus would be as to what do companies comment with regards to the second half FY23 outlook. What do they suggest with regards to the deal wins and the hiring patterns? Certainly, from a hiring standpoint, I would believe that we should ready ourselves for some normalization in hiring after the record addition that we've seen in FY22 across the board for the industry.
This is the first time that we've seen a real derating as far as IT names are concerned from quarter to quarter. For the last 4 quarters, you always saw stocks hitting new high, EPS upgrades coming in. How does that put the numbers in context? This time around, our expectation low? Are people neutral to underweight on IT?
So I'll first of all give a background that with the 4Q results itself, we were expecting that the upgrade cycle will take a pause, if not reverse towards a downgrade. Subsequent to that, over the last 2 to 3 months, there have been significant currency moves in addition to concerns around demand. So with the way cross currencies have been moving, certainly there will be downgrades to USD revenue growth estimates across the board. Some of us have already penciled in moderation in terms of USD growth assumptions. From a earnings or a margin standpoint, Rupee has depreciated versus the dollar, but Rupee essentially is appreciated against other currencies like GBP or Euro, and thereby the net flow through to margins for the companies will be minimal. But at a net level, I would say net impact on margins and earnings might be slightly positive because of the way Rupee has depreciated.
Right. So, what sort of a Rupee number would you build in going into next year? Because, this is something, which you would have your internal team predicting the numbers. It's going to depreciate more. Your view is that it will remain where it is. So what sort of upgrade would come in on the basis of that? And traditionally, we've seen that in the last 3-4 years, they have been slightly lower insulated to Rupee, as in their hedging mechanism has increased and they have tried to make the sensitivity lower, at least for the larger ones. So how much of that impact would be there?
So as of now, our current assumptions are building in about 77 to $1, though our in-house forecast on Rupee essentially suggests Rupee drifting down below 80 rupees to a dollar as well. So yet to take that into account. But if you look at the sector as a whole, uh, a lot of the currency-led gains typically tend to get passed on to the customer, and thereby some of those gains at a net level are very limited, barring the translation benefits from the currency flow through. So I would say currency doesn't drive a significant upgrade as such in a significant manner for the sector as a whole. The only thing that it does essentially is that it makes Indian IT much more competitive, and and given the current environment wherein globally customers are facing high inflationary environment, there is increased impetus on optimization. That's a dynamic that is typically positive for offshore IT. But in the past, we've seen that this typically tends to play with some amount of lag. So I will not be surprised if the commentary from companies during the current quarter shifts uh, towards reprioritization of client spends, wherein customers are once again looking for more cost savings. And as I said, that typically tends to play to the advantage of Indian IT companies.
We've seen in the last 3-4 quarters that mid-cap IT, of course, in percentage has grown higher because of a lower base. But some of these names like Mindtree, both the L&T twins, Coforge, they're no longer small. So do you expect that outperformance to continue in terms of percentage?
Still, there is a significant scale difference between an Infosys or a TCS compared to any of these tier two companies. Just to give you some sense, a TCS on a quarterly basis does in excess of about $6.5 to $6 billion plus in terms of quarterly revenues, and the absolute revenues for any of the names that you mentioned is probably a third or probably a fifth in some cases. Okay, so there is still a significant scale difference. The tier two companies do benefit from a favorable base, and over a period of time have also benefited from the fact that at an industry wide level one has started to see, or over a multi-year period, you've seen deals being broken into smaller sizes, and thereby they are not at a disadvantage when it comes to tier one or scale players in terms of competing for that business. I do not think that dynamic is changing. The only thing that needs to be watched out for tier two companies is that still there is a fair amount of uh, high client concentration there. So pick up any mid cap name, typically you will find that the top 10 customers would make 40 to 50% of revenues there. And in case they see any demand headwinds in a couple of clients, that tends to translate very quickly in terms of their financial fortunes.
Great to have you on the show. Thank you so much for taking the time out and speaking with us today and highlighting what to expect from IT. TCS, remember, delivers its numbers today, post-market hours. And be sure to catch all the action right from the TCS headquarters right here on ET Now.